understanding market calibration and contingent claim analysis in early stage of company valuation. For this, please give him a round of applause for Mr. Umakant Panigrahi. Over the dice, please. Please, sir. While I speak about Mr. Umakant Panigrahi, he is a managing director at Valuation Advisory Services. Umakanta is a managing director in Kroll based. Please, sir, have a seat. Meanwhile, I'll just let people know about your experiences. Umakanta is a managing director in Kroll based in Mumbai. In his current capacity, he is responsible for the overall financial valuation practice of India. He has over 20 years of experience in financial advisory services, including valuation, fairness, opinion, disputes, restructuring, equity research, credit research, and other advisory services. Umakanta has managed a range of mandates, including business valuation, intellectual property valuation, complex capital structure valuation. He has also advised several clients on swap ratio determination, corporate finance, business plan development and review, exit strategies, and shareholders' disputes. He has managed and executed a range of financial advisory engagements for energy, utilities, infrastructure, private equity, insurance, financial services, healthcare, telecom, media and entertainment, retail and ITES industries for mergers, acquisition, accounting, taxation, reporting, transfer pricing, litigation, dispute resolution and strategic purposes. His specialization includes valuation of complex financial instruments such as complex convertible instruments, earn-out and contingent payments, cross-currency interest rate swaps, options and other hedging instruments. He has also advised several companies on distressed debt transaction and earn-out structuring and ESOP structuring. Prior to joining American Appraisal, Umakanta has worked with the financial advisory services practice of Deloitte and investment research and valuation team of Evaluaserve. Umakanta holds a Master of Business Administrative degree and a Bachelor's degree in Business Administration from Utkal University. Umakanta is also a member of the Royal Institution of Chartered Surveyors, MRICS, Undervaluation of Business and Intangible Assets Pathway, and holds the Certified in the Entity and Intangible Valuation, CEIV that stands for, credential from the American Society of Appraisers. That's it, and I think there is more to it. So please give him a round of applause. Before we start with the session, I would like to present the memento to him. Please, sir. Ronak, please help me for that. Amy is also coming. Acha. We have one more speaker with the Umakanta, who is Amy Sangvi, the Sangani, Associate VP. Please, ma'am, come over the stage. Please give her a round of applause. So probably they'll present together to give us the insight over understanding market calibration and contingent claim analysis in early stage of company valuation. Thank you. We'll take a you want to keep your laptop?
Thank you for, I think, flattery introduction, Dadar. Yeah. And good afternoon, everyone. I know it's a difficult task for both speaker as well as being an audience post-lunch session. Okay. So, but we'll try to, make it more interactive so that, instead of course, there are bunch of slides are there, which of course, okay. Yeah, so we have put together a bunch of slides, but all of us know these days using ChatGPT or Copilot, you can make better slides than this. Okay, but we'll try to make it more probably interactive so that we understand primarily what are the challenges we face when we do early stage company valuation. Um, so, but just before that, in the audience, how many of us are into valuation as a profession? Okay, so quite a few, and I'm assuming most of us also going through early stage company valuation because that's what is selling today in India, or rather, last decade or so. So the way we have structured our presentation. We will talk about a little bit of regulatory framework, the why market calibration is required, because a lot of time we not only do the valuation for transaction purposes, but there is a regulator, whether it is our auditor, whether it is SEBI or let's say SEC, EICPA, then they look at what you are doing. Hence, what the regulator framework with respect to market calibration and CCA. Then we talk about some of the key concepts and different methodologies to do that, and we go through both all three methods. Okay, so when it comes to again, just feel free to interrupt me instead of doing a Q&A at the end. If you think any of the slide you have any questions, just feel free to interrupt me so that we can clarify them at that point in time. So if you look at, there are several standards we look at it, right, for our daily life when you're doing the valuation. We have accounting standards, which is generally prescriptive in nature, right? You cannot deviate how, let's say, revenue should be accounted, how, let's say, expense should be accounted. But when it comes to valuation guidance, most of them are actually prescriptive in nature. Okay, not that it's a guidance you give you, it's a framework it gives you. You, let's say, for example, we all of us know to value any asset you can use income approach, market approach, cost approach. Now income approach, you can have a different ways of looking at it, right? That's why when you look at valuation standards, it is always a guidance. Okay, not that you have to follow as a prescription. It's a guidance. You can probably have your own perspective or understanding, and accordingly you apply. So that's why I'll probably suggest all of you to go through AICPA or some of the other guidelines, or IPV particularly, because that gives you a lot of insight with respect to how early stage company to be valued. Of course, I think IPV guideline will be with respect to financial reporting valuation. It is primarily to see, okay, whether LPs of the funds are protected, because at the end of the day, GPs will do the valuation of their portfolio companies, and they will say, hey, this is how the NAV is moving quarter on quarter. But that gives you a broad sense that, okay, how probably early stage companies valuation should be looked at, and how this this calibration plays a critical role. So this I spoke that it's a framework which you get from IP guideline. I'll not spend too much of time. Now this is the slide. I think we should spend some time. Now this is the life cycle of a company, right? And when it comes to early stage company, primarily you see the early stage companies will fall under first two buckets, okay, where you have either early revenue stage, no revenue stage, okay, or rapid expansion. These are the two area, these are the three broad buckets of revenue life cycle which you see. Okay, now what are the challenges we face? Because unlike if you are valuing a stable company, you will have a probably longer historical financial information, which gives you more comfort to see what kind of growth rate the company is at what kind of growth rate at which the company is operating vis-a-vis your peer set. Okay, what kind of profitability, what are the other challenges? But it comes to early stage company, it is a black box, right? We don't know what the company is doing. In fact, when you ask VCs, what is the basis based on which you invest? Do you really do any mathematical calculation? There's honestly, we don't do any valuation to decide whether I should invest in the company or not. What they look at? They look at, okay, is that the product which they are or the services that trying to sell has a real need in the market, and what is the management? Okay, and these are the two aspects VCs mostly look at, and based on that, they probably decide, okay, this should be the pre-money valuation or post-money valuation we're talking about. So that, creates this challenge that, okay, as a valuer, how do we then, have some, place some reliance that, okay, fine, there is a lot of, I think subjectivity there when it comes to valuation of early stage company. But if someone, let's say, say, okay, is there any science you can actually place reliance on? That is where this market calibration plays a big role. So as I said, I think early stage company will have a less or none operating history. You hardly get any comparable companies because each business, each model will be unique. And I think most of the value, you have this discrete period, you have terminal value. If you try to do a cash flow analysis, then your almost 100% value will come from terminal value. So that makes the whole valuation very, very subjective. In fact, I'll give you probably one incident, which most of us would have probably gone through that. A couple of years back, we have this, I think income tax department still contemplating to, abolish this angel tax, right? So 2.5 years back, what happened? More than 1,000 startups, they got, a notice that, okay, hey, there is a notional, tax which you are supposed to pay, you are not paid. So what is the basis of that? Because most of us, we have been using, discounted cash flow analysis to value any business. Okay. Now they say, okay, hey, when you raise funds, you had projected that year one EBITDA will be 100 crore or 50 crore, and year two EBITDA will be whatever value. Now, when subsequently when they've seen instead of 50 crore EBITDA, you've actually achieved 5 crore. Which means if we issued shares at 100 rupees per share, but ideally it should be 10 rupees, so you pay tax on 90 rupees. Right, that the challenge came. Now, if you have only done valuation using discounted cash flow analysis, there is no way we'll be able to convince income tax authorities that no, that was the business plan at that point of time. Hence, things have changed. It's become very, very different. Argument. So I was quite a few, my clients also had received similar notice, and I happened to have at least, 2 meetings with, assessing officer. So when we do the valuation, this, the discounted cash flow analysis become secondary. It's just for a cross check. Your primary method should be a market approach, because that is what is, you can actually demonstrate that, okay, hey, I don't know whether, this valuation is correct or not, but I know there are n number of market participant players that decided to put money on this edtech company at $15 billion valuation. So I may be wrong. Not that, all these 10 or 20 investors, they can be wrong. So that becomes a probably strong point to say that, okay, different people or different investor will have a different, access to information. Based on their access to information, knowing for the fact that this company, I don't have any information available, and still I want to put money, or they put money at X pre-money valuation or Y post-money valuation. So that becomes easy for you to place the reliance. That is why I think this market calibration becomes a critical or key concept when you do an early stage company valuation. I just move anyways. I think all of us know that what are the different life cycle for early stage companies, or rather they are life cycle of a company. Okay, so now the concept of fair value, all of us know, right? What is concept of fair value, right? When there is an audit transaction and the deal is happening between two knowledgeable parties, that is where you talk about this is the fair value, or the value at which the transaction is happening. That is the fair value. Okay. Now, of course, when you are investing in any early stage company, and you are also mindful of the fact that the company will have a much higher growth story. Okay. Most of the time, when you look at a business plan, also you'll see a hockey stick, projection for early stage company, right? And that is the expectation, right? That yes, in spite of that, there is a deal which is happening between willing buyer, willing seller, and that is how we are talking about the fair value. Now, there will be situations where which happens, a lot of time. And I can give you an example. I used to value Uber. Okay. In fact, we as an organization used to value Uber for 14 different funds, including Tata Capital in India. Okay. Now, what is to happen that different investors will have a different access to information. In fact, I got to know that when we are doing some of the valuation, Uber is a company that become, they are so adamant that okay, you want to put money, you are writing a check, less than $500 million. We are not going to give you any information. You do your whatever public source search, and if you are willing to put money, you put money, right? Now, if you look at different funds will have different, access to information. Okay, like there are funds will have access to information with respect to MIS, historical information. There are funds who will have access to business plan. At the same time, there are funds who will be also sitting on the board of the company, where they have some influence that okay, what the right call for the company, what is not right call for the company. Hence, you will see that okay, companies actually or the funds coming with different valuation, because if you have access to business plan, you can do a more meaningful analysis about the company vis-a-vis just simply looking at the MIS, because you don't know. I mean, what is the growth story, what is the probably prospect of the company. So because of that reason, you cannot say that okay, hey, there is a fund who invested based on only publicly available information and X valuation, and the fund which is investing with the business plan with the Y valuation, both are wrong. No, it is basically fair value considering the fact that okay, this is the information which is available. Now, information availability changes, right? When you invested, you expected that next year growth rate will be 50%. Now, 3 months down the line, you realize it doesn't look like the company will be able to achieve 50%. You recalibrate your number. You say, okay, if I had expected 50% to be, the future growth, based on that I had given X valuation. Now, within maybe a quarter, I realized that, no way the company will be able to achieve 50%, and I recalibrate and probably adjust the valuation downward. That's why I think what information and you keep updating, your valuation based on the additional information which is coming. Okay, so which means the day one when you estimated, the value with limited information does qualify to be a fair value round. Okay, so I think in terms of accounting standards or the guidance, which I think whether it is ICI, valuation standard, or we're talking about IVSC or some of the accounting standard also, I think fair value definition is pretty much similar. But what is not the fair value, what will not qualify as a fair value, which you cannot consider for market calibration. If there is a deal happening between two related parties, we have seen, we see that quite often in early stage company scenario, where existing investor, they will keep on infusing money at a higher valuation. It goes up, okay. And from the, I think, standard point of view, from the both accounting as well as valuation standard point of view, any transactions happening like we call it like rights issue. Why regulatory authorities, they allow to have rights issue at any valuation? Because you are only giving that opportunity to the existing shareholders, okay, and your shareholding is not changing. If somebody knows that okay, by not participating, I'm going to dilute myself, that is their call. Okay, so that is why rights issue sometimes happens at any valuation. It has nothing to do with nothing to do with the fair valuation. So that's why even a deal happening between related party, that will not qualify to be a fair value benchmark. Okay, now sometime deal happens at distress. We have seen your return expected sometime is very high in distress. You can say okay, hey, distress, the company is distress, hence probably that would have still on the fair value. But still from I think fair value measurement point of view, when you're doing the valuation, particularly for financial reporting purposes, generally distress transaction will not be considered as the fair value benchmark and use that for your calibration. So that you can be mindful of. Second, I think the principal market. So that we know, let's say we are talking about there is a product which has been developed. Let's say it principal market is, let's say for that is, let's say, India. Okay, or let's say there's a product which has been developed. The principal market for that could be a particular industry. Let's say we're talking about some technology. Now you have principal market changing because maybe I'll give you this pharma example that will be more relatable. Now all these pharmaceutical companies, they do research on on therapeutic area. Okay, then they do research on some indications. Now, if indication is changing, let's say when they start researching at the clinical trial level, they think, okay, this can only be used in one indication. But over the period, they realize that, okay, this product has usability in multiple indications. That changes the valuation. So that's like the principal market. Either you look at from geography point of view, or look at the the industry, the product or services targeting. That becomes critical. If it's changing, then of course and that will not suggest that it has been at the fair value. Unit account is again a critical concept when you are before doing market calibration. Now, day in day out we see transaction happening in early stage companies. Now, most of us know, right, early stage company investments happen in preferred capital, right? So there is a difference, right? There is a difference between why early investors prefer to have in preferred than common, right? Because preferred will have probably higher rights, okay, or preferential rights as compared to your common. So that is why you see most of the startups or early stage companies investments coming in preferred, so that they are protected. They are actually, while they will let the promoter or they will let the founder to have common series, whereas they will have the investor coming is preferred, so that they have this liquidation preference and other preferential rights will help them to get an exit or get a probably higher cash payout in case of a transaction. So now let's say when you are doing a calibration, you need to identify what is the unit of account, okay, because your starting point with the last transaction value. If there is a transaction which has happened at at preference capital, you cannot use that as a basis to value common, right? Because common will not have any liquidation preference. Common will not have any probably other rights which is superior to preferred. So because of that reason, unit of account will be critical. That okay, if when you're doing calibration, make sure that you calibrate for the same round. And if you don't have that, then that is where this contingent claim analysis which will come, which we'll discuss towards end of the presentation. So before moving to calibration, yes. Different. Absolutely different. So I'll give an example. Let's say there are two series of, or let's say there are same series happening. Okay, you will have series A1, A2. A lot of time you see, right? Probably strategic investor is coming as series A1, whereas other financial investor is coming, let's say series A2. Now let's say there is a liquidation preference is different. Okay, series A1 has let's say 2x liquidation preference. Series A2 has 1x liquidation preference. So there has to be a different value. And also we have seen a lot of time, at the same point of time, transaction happening, there will be a primary round, there is a secondary round. You see primary round happening at a higher valuation, whereas secondary round is happening at a lower valuation. Yes, absolutely, it will have. Any other questions before we move to market calibration? That's correct. Yes, you have to. I mean, although, unfortunately, I had this challenge dealing with both, I think, income tax as well as, RBI. Now, lot of time, we do valuation for FEMA purposes, right? Now, if there is an investor which is overseas investor putting money in, in preferred capital, most likely we'll do a valuation on a fully diluted basis, multiply proportional stake and get the value. And but that's not the right value. Okay, we try to explain that, okay, and how you can actually, and I can tell you that in a seed stage to series A stage, okay, preferred capital having a 1x of liquidation preference, and if you think that and the company can go for IPO not before 4 to 5 years, difference in value can be as high as 40%. So common will be at a 40% discount to preferred. Similarly, if you make the liquidation preference 2x, okay, that becomes your common will be almost 60 to 70% discount to preferred. So, but it's become little, difficult these days to explain, regulated. But I'm assuming that it is, things will, fall in line coming, going forward. But I'll give an example. We are doing one dispute engagement where, of course, it was there in the US code, where there was a dispute between two shareholders, and the shareholder which was getting an exit, where in this case it was, the founder, a founder had getting an exit, and because there was a last round which happened, and the founder was saying, hey, I should get an exit based on the last round. The last round happened at Series E, which is much higher, okay. And in the legal in the dispute in US court, basically, gave this order in favor of the investor. No, common as a promoter, because you are holding common shares, so the valuation cannot be the round which happened probably 2 months back, because that round happened and preferred. It is not only for financial reporting purposes. We see that also getting used or implemented in dispute as well as transaction scenario. I said that you see transaction happening both primary and secondary. Secondary always will have at a lower end, at a lower level, because the secondary deal must be happening at the early stage, which is basically a Series A, Series B. Well, let's say primary is coming in Series E, so there is a difference because of their liquidation preference. Series A would have come, let's say 10 rupees per share, whereas Series C, E would have come, let's say 100 rupees. So because of that reason, the valuation has to be different, which we see, being followed, in practice in transaction scenario as well. Yeah. Okay, so now this is a common I think confusion happens when you talk about liquidation preference. You go to any shareholder agreement. Okay, the liquidation preference, the way it has been defined, any liquidity event. Liquidation preference doesn't mean the company is getting sold, company is getting bankrupt, and liquidation preference is coming. Liquidation preference is if there is a M&A happening. Okay, whatever price coming, that is also qualified liquidation preference. No, unless that funding is not there, because funding is coming for future growth, then money cannot be used to retire another shareholder. It is only in M&A scenario. Yes, you have to. No, when the new investor is coming, okay. Now we are saying that, let's say there is a funding happening. Let's take an example. There are already two series of shares are there, Series A, Series B. Okay, and there is Series C funding coming. Series C shareholder, okay, will come at a premium. You can't say that Series A is also should be valued at the same price. That is the difference. Yeah. Yes. Right. No, so I think this anti-dilution is basically, if there is a down round happening, that is going to get impacted. Yes. Yes. Yeah, so that is why, in fact, if you think, let's say, there are, let me give you an example. Let's say Series A, Series B, there are two series of shares are there. Okay. Now Series B happened, let's say at 100 crore valuation. Okay. We know that Series A has lower liquidation preference, and implied valuation for Series A should not be 100 crore, maybe it will be, let's say, 90 crore. Now, let's say Series C is happening at 90 crore. Okay. Now, because there is a liquidation preference which is there, for Series B, okay, their valuation will not undergo change. They will still at whatever valuation. So that is how it is. It is going to get impacted. Okay. We'll move, or any other questions on before moving to calibration. Okay, so what is calibration? Okay, so calibration, always whenever you have to consider subjective aspects, as we are speaking for early stage companies, there are a lot of subjective aspects, because there is less or no prior history. The company is not making revenue, while the company is saying that they will make profit, but we don't know when they will make profit. So that's why when you do the valuation, there are a lot of subjectivity is there. Okay, now as a valuer, what kind of objectivity we can bring, okay, in valuing those companies? That is where saying we can do a market calibration. What it says that okay, you can use an observable input. Okay, let's say there is a deal which has happened, coming back to our example, let's say there is a deal which has happened, let's say 3 months back, the company was valued at 100 crore. Now that becomes a starting point. Now from there you see that okay, whether 3 months down the line, 6 months down the line, or 1 year down the line, that 100 crore valuation should go up to stay at that level, should come down. What kind of, because 100 crore, there is a willing buyer, willing seller transaction happened, and we know that the investor who is putting money, they understand the business, hence the 100 crore qualifies to be a fair value round. Okay, if the 100 crore have been, let's say, between related party, that will not qualify as a fair value round. So you cannot do a market calibration using using a value which is not qualifying under fair value. So only you can use fair value round. Let's assume the last round which happened, that is qualifying as a fair value round. So that becomes a starting point. Then from there you try to do two kind of assessment, or one is you look at how the market has moved. Okay, now we know we will not get perfectly comparable company, but we know that we can look at a broader set. We can look at okay, how the market has performed. Let's say we are talking about we have valued a SaaS based company which is targeting to e-commerce. Okay, or let's say you are talking about edtech company. Now you look at this deal happened 6 months back at 100 crore valuation. Now in last 6 months, how the market has moved. Okay, even though we are not getting it, as I said, perfectly comparable company, because directionally when you are looking at broader industry level, you can say okay, if Nifty has gone up by 10%, I think our companies would have gone up also. I don't know whether it should have gone up by 10%, but certainly unlikely it would have come down. Now similarly, instead of Nifty, let's say you got, let's say, 5 comparable companies which are publicly listed, you see that okay, these 5 companies, the growth in last 6 months is let's say 30%. You say okay, fine, I don't know whether they're not perfectly comparable to my business, but directionally I am seeing the market has gone up. Okay, if this deal would have happened today instead of let's say 6 months back, most likely I would have given a higher valuation than 100 crore. So that becomes one starting point. You look at your look at how the what was the valuation which has happened, and look at the market performance. Then second, you look at probably how the probably company has performed. Because when you do calibration, okay, you also try to look at the company performance, a historical period, whatever limited data available, what they're projecting. Okay, then you do a market assessment and do a company's own performance. Based on that, you actually adjust the multiple and get to a probably what's the valuation on a current date. So, for example, Ami, you want to probably take through the example so that But before that, I think one other concept I want to explain. In market calibration, you will have a pre-money calibration and post-money calibration. What is pre-money and post-money? We are talking about, let's say, in this example we are giving, pre-money valuation is 100 crore, and the company is expecting, as part of the round raising, let's say 10 crore. Okay. Now, when you are estimating what is the implied multiple at which the deal happened, you look at 100 crore, let's say pre-money valuation, divide that with, let's say, 10 crore, which is current revenue, you get 10x of multiple. Okay. If you do that valuation, what will happen that, then you add back cash. Okay. But if you, both, I think, under, AICP or IPEB guideline also, they prefer that you should use post money, because the 10 crore money which you are raising when you are agreeing on a pre-money valuation 100 crore, post money become 110 crore. This is under the assumption that there is a growth story which you are probably building for the company. That growth story can only be achieved if you are getting this 10 crore. If this 10 crore is not coming, then 100 crore valuation is also will not happen. So that is why is always you should probably, while perform the calibration, you use post money valuation, so that you know that the cash which is getting used for future growth is also accounted in your implied multiple. you want to talk about the probably case study?
Hello everyone, am I audible? Yeah. So quickly about myself, I'm Ami Sangani. I'm a chartered accountant, and coming back on this forum gives me nostalgia, and I'm very grateful for this opportunity to present to the fellow fraternity members. Thanks Umakant for bringing me here. Quickly on what Umakant added on calibration, okay? So like he mentioned, why do we calibrate, okay? We can simply use, say, a market approach, right? Ultimately, calibration is, you starting from what had happened, say if an investment, like he mentioned that if a round happened at 10x, from then to now, how do you see the company moving, okay? And there are various factors of how do you give the impact, okay, on the valuation. So just want to understand, that why calibration and why not a direct market approach? Anyone wants to answer that? Okay, so quickly, moving on to the very first slide that Umakant shared was that in early stage companies, right? What happens is the company is still in the development stage. The idea is there. Now they are putting money into that idea, growing that company, and making it's in the stage of establishing itself, right? So in that case, using a direct market approach won't be relevant, because in the market, all the companies or the listed players are well established, okay? And they are mature companies. And that's why you cannot directly use a market approach, and hence calibration is one of the most relevant approaches, okay? Moving on to, the case study. So there are two factors. There is one which you account for is investment specific factors, and the second is market specific factors. So what is investment specific factors? Okay, for example, when you invested in a company, the company expected a growth trajectory of 10 to 50%. But today, because of various reasons, the company has not done that, okay? So first, not meeting the milestones. Second is product-related risk. For example, when you entered the market, your product had a value. Now, because of certain reasons or competition or substitute, the product itself has lost value. So that's the second investment-specific risk. The third is, the long-term outlook, quality of management, if there's a lot of attrition, okay? In early-stage company, the management strength plays a very pivotal role, okay? They are the one driving the business. It's their idea, and they have to do the execution from early stage to a mature stage company. So if there's a change in management, even that plays an important role. These are pure company-specific factors. Now, there are certain market-based factors. For example, say that there was Uber. If Uber started a bike rental services, like how you have Uber, you can book a taxi. You could even book a bike and you could go from one place to another. Now, certain governments banned that, right? So that's a broader regulatory. If the government or the broader market has changed some, then of course there's a risk in the investment or the projections that you'll have made. So that's a broader market based factor. Second is interest rate. In COVID times, interest rate peaked up, okay? Now they are better. So all of these are market. Can you control? Can the investment company control? No. And hence these are market-based factors that we have to consider in our valuation, okay? So quickly onto this example. So this example is very simple. Just adding on to Umakant's number, that if I invested in 2024, say at 10x of revenue multiple, now I'm valuing this investment in 2025. Will I still value at 10x? Everyone, will you value at 10x still in 2025? Yeah, not necessary. So Nishant, very smartly, he just didn't say no. He said not necessary. Why? It can be 10x. It's not that it cannot be 10x, but you have to evaluate. What will you evaluate? The two things that we discussed. One was investment-specific factors and one was market factors. If the market has gone up and the company has performed, you will give the company benefit of both. Okay? You will give the company the benefit of market and the investment. But if one has gone up, a market-specific factor has gone up, but investment has not performed. So in that case, maybe the multiple is 10x. Okay? If both are down, it can be lower. Okay? So this example just talks about that when you entered the market, you entered at 10x, and that you paid a premium of say 10% on the broader market comparable, and that premium was for the growth and the EBITDA story of the company. Now that company did not achieve it. So in next year, I would have not given that 10x premium, but I would give a slightly lower premium. I'll not give a premium at all. So this is, how you will incorporate the broader market and investment specific factors in doing calibration. And you cannot just directly take the implied multiple at which you entered the company.
So one, I think, why the calibration, helps us, because you can do more objective assessment. As I said, in early stage company, that market has gone up. Okay. Now, hence, my 100 crore valuation should go up. Whether it should go up by 10% or it's equal to what market is moved, that subjectivity could be there. But otherwise, you will find objectivity between between the last valuation date and current valuation date, which will help you say, okay, fine, it is at least reconciling to how the market has performed, how the company's metrics is also moving. And one other aspect also we need to be also mindful of now in market calibration is multiple amortization. Okay. Now, when the deal is happening in the same example, let's say the last deal had happened, let's say at 10x of revenue multiple. Okay. Now the 10x of revenue multiple happened because you are expecting next year growth will be high. Okay. Now 6 months down the line or 1 year down the line, your metric has moved up by 100%. Now you cannot apply same 10x multiple unless you expect that, okay, no, now when I was actually valuing the business 1 year back at 10x revenue multiple, I had thought of that I can only operate in 3 a region. Okay. Now my I think horizon has increased. Now instead of 3, I can operate in 6. Okay, so because of that reason, next year also I'll grow again 100%. Unless that is not changing, you don't see a probably higher growth opportunity. That the 10x needs to be amortized because you had expected high growth in the first year. You already achieved. You amortize the multiple to factor in the already growth which has been achieved, in addition to, of course, your market movement. So that I think, just be mindful of that. Don't just apply 10x to the revised, LTM revenue or LTM EBITDA, whatever you're applying. The simple example, I think, self-explanatory, I will not go through it. And this deck will be shared with the participants, right? Again, I think most of us know about some of these methods. In the late stage, of course, you have income operation, market approach, because you have reliably probably use these data points to evaluate late stage companies. But it is basically when it comes to I think early stage where that is where the challenge happen, and you have to use some of these fancy valuation methodologies, lack of any better word, to estimate the valuation of the company. And to speak on the market approach?
So quickly coming on to what is market approach, right? Market approach is you taking comparable companies of your investment subject companies, comparable companies, and then deriving a multiple and applying a multiple to your subject company. That is guideline public company, and there's one more which is called guideline transaction company, where you look at the recent transactions that have happened in the market and try to benchmark your transaction to that transaction and apply a multiple. Now, why am I talking about market approach when I clearly said that, you can't directly use a market approach? Anyone wants to give a thought? Okay. So, when you're doing calibration, right, you start with your implied multiple, okay, that you entered at 10x. But now going forward, what will you do? Okay. Going forward, I'm going to look at the investment specific factors and market specific factors. When I'm looking at market specific factors, I'm also going to look at how the industry or the market has moved. Now, for me to do that, the best way or observable input is the comparable companies, right? So when I invested, say the comparable companies were trading at 5x. I entered the transaction at 10x. 1 year down the line, say the comparable transactions multiple is 8x, okay? So now I also have to peg my entry multiple to that multiple, right? So what has changed in the market that in 1 year the multiple has moved so much? Is it relevant for my company also that I should increase the multiple or not? And hence market approach becomes a relevant concept when you're using calibration. You can also do calibration through income approach. What will you do there is that when you entered, what was the broader interest rates in the markets, and when you're recalibrating, what are the interest rates? So you do a comparison of interest rates when you do income approach calibration, but broadly and majorly what we do is we do it market-based calibration. So this is a case study of market-based calibration. So just building on what Umakant earlier said, so if you see here what we talk about is that, say a 10x multiple, okay? And then I see that the market has moved up by 10%. When I say moved up, I see that at calibration date, the multiple was, for comms was 5x and now it's 5.5x, right? So that's a 10% increase in the market. So do I apply that 10% increase directly to my investment company? Anyone? Not, I heard someone saying not necessary, but yeah, that's right, not necessary, right? But I will have to evaluate how much I have to increase, and it's a subjective call. But you have to still give the impact of the broader industry. If the industry is moved positively, you and your company is in that industry, you will give them that positive. So there is this market adjusted rate multiple and increase and decrease in multiple since market calibration. So we see that how much the movement is, and to some extent we give that benefit to our investment company. The next is, if you see, is a company specific factor, which we discussed are the company specific, investment specific factors. For example, performance, milestones, change in key management, etc. Right? So for that, and fourth is amortization, what Umakant mentioned, that if the growth has been achieved, right, then you will start to amortize that multiple and get to the industry multiple, okay? So that is also something that you factor when you look at investment specific adjustments. And that's how you calibrate. So say for example, the 10x was a starting point. Industry has moved 10%, so it will become 11x. But the company has not performed well, so you might give some discount, okay? And bring it back to say 9x, for example, if it's a 20% discount. So that's how you evaluate the factors and do a calibration.
Maybe if I add some perspective. Now let's look at the whole idea of using calibration is to bring objectivity, reduce subjectivity. Let's look at what are the subjective aspects there. How you can actually get some more comfort on the subjective aspect. So until in this example, until 1.6x, which is basically implant multiple, so there is no subjectivity. It's simple calculation. Now we are talking about first subjectivity is 2.5%. So this 2.5% is coming either you have looked at broader industries, okay, look at how they have moved. Now let's say you identified 4 or 5 out of let's say 10 companies are probably close comparable. Now and those companies, let's say they've gone up by 50%. Okay. Now one thing we know, private companies are less volatile as compared to public companies. In a good scenario, we see public company in a day goes up by 20%. Nothing has changed, right? Do you think their future cash flow is changing by 20%? Hence, stock price has gone up 20%? No. Generally, public company will be more volatile, both in terms of upward movement and downward movement. So because of that reason, generally as a thumb rule, you take anywhere between 50 to 75%, to be your market movement, because our company will not be that volatile, and even if a good scenario, it will move up less. Second best way to look at, okay, what is the target market I'm looking at? If I know that I have selected these 5 companies, okay, to benchmark, and they have grown by 5%, what is the target market they are they are into? If the target market is similar, you can probably take as it. If you know my target market is for broader, okay, hence you can actually adjust upward or downward based on that. So you will have have some justification if you are deviating from that 50 to 70%. And second, of course, in the company specific factor will be based on, in this case, because I think revenue from the calibration is pretty much flat, hence there has not been any change. But if you think there is any change happening, as Ami was mentioning, let's say regulatory framework changing, like you talk about this, let's say two-wheeler, ride sharing companies. Now some of these all of a sudden in between Maharashtra decided no, because there is some incident happened. They said okay, no, there is no more such operator can operate. We can only have four-wheeler. Something happening, your target market is reducing. Hence you have to apply another in a company specific adjustment to factor in that. And you can to bring more objective, you can say okay, hey, so Maharashtra is the only state which is now banning this two-wheeler ride sharing. Now what is the Maharashtra's market? Maharashtra is contributing like say 10% of overall 100% what revenue I'm expecting from India. So you can say okay, fine, I should probably reduce 10% okay of the overall market, and based on that if you think by reducing adding 1% alpha, it reducing 10% value, and you say okay, that is the justification. So you can try to do have some industry or other data points to justify this the percentage increase or decrease which you are doing. That was so one before this there are two kind of calibration we are speaking about. One calibration based on the transaction which has happened in the company itself, subject company which you are valuing. Second calibration we are talking about doing calibrating from market point of view. That okay, if there is no deal which has happened, or the deal which has happened probably little dated, hence I'm using market approach. Now when market approach calibration from comparable company's point of view, there you should ensure that okay, these comps are actually a little more comparable, then only you can do. Number one. Number two, if you think that okay, last deal which had happened actually dated, hence using that number now to calibrate, it doesn't make sense. These are two scenarios you can decide okay, where to use market calibration from comp set point of view, where to use calibration using your own implied multiple which you would have got probably whatever 6 months or 1 year or 2 year back.
So this example is about, so just moving on to the previous example, this is what Umakant mentioned, that calibrating from your own entry multiple. And this example is more from calibrating from a market perspective. So when I entered, I was at say 10% premium. Going forward, whether that premium or discount will be there or not. The third is a simple case study or presentation of guideline company transactions. Ideally, what happens is you directly cannot benchmark to a transaction. Why? Because the transactions that happen in private market, the data is not widely available in terms of how the deal was negotiated, whether there are any synergies, whether the data, like to compute the multiple itself, the data might not be relevant, and whether it's 100% acquisition or 20%, whether there's premium on control applied, and hence you directly do not use this as a multiple, but you can use it more from a corroboration perspective. That if today you feel that the subject company that you are valuing is in the range of say 5 to 10x, and the deals are also happening in that range, that can be more from a corroboration perspective.
Just one other thing which I want to mention on transaction method. It's pretty much used in very early VC stage companies. I just said they don't do any mathematical calculation, only speaking, to decide what is the valuation. They just say okay, fine, we want to make investment because the product and services that's going to sell has a real need or real potential in the market. Second, I like the management team, they have adequate expert. Now when you move year and year, the one of the approach you probably you can take from transaction method, that what is the pre-money valuation. You don't calculate multiple at all. You don't look at revenue because you will not have any revenue. You simply look at what is the pre-money valuation. Now let's say you talk about seed stage company, look at in tech segment, in seed stage companies probably 5 year back or 7 year back, their valuation range was anywhere between $3 to $5 million. Now today, if you look at seed stage company, the technology segment, it has increased. It has become 5 to 7 or 5 to 10. So you look at, that what is the market, how the transaction multiple, not multiple, sorry, transaction pre-money valuations have moved actually over the period. Okay, and that sometimes, gives you some comfort that, okay, hey, market is also has gone up by 100%. Hence, our valuation should be not without any other additional information. Second, let's say classic example is, let's say, EdTech. Okay, now we know. I mean, it is after Byju's fiasco, there is a sharp decline in EdTech company valuation. It is not only impacting the subject company which is actually going under this stress, that has also impacted the market sentiment for other EdTech companies. The general sense is that, okay, your riskiness attached to EdTech companies has gone up because of XYZ reasons. Hence, earlier probably you are giving X multiple, the multiple contraction which happened. So that is also one way of looking at a transaction multiple to put some reliance, saying, okay, hey, whether directionally, keeping everything as it is. You had a business plan, you had a thought process, okay, business going as it is. If things are going as per the plan, whether directionally market is moving up or down. We'll move to contingent claim analysis. I know I'm mindful of, I think we have, I guess, another 30 minutes. Yeah. So we'll keep some time for Q&A. Before moving to contingent claim analysis, any questions on, yes. If I understood correctly, you are saying if you are valuing a deep tech companies, which is raising a early VC stage. So that is exactly mentioned. One is did I understood your question correctly? See, I think that is where the challenge happens. A lot of time, in early VC stage investments, the proof of concept is not there. There you don't put money based on the business model because you don't know whether real need or not. First thing you need to establish there is a real need for that product and services, and there are deals happening. Okay, it may be slightly different stages, but these similar kind of products are getting sold. In fact, I'll give you one piece of information. So we do a lot of early stage company valuation, and we have done some research over last 10 to 15 years. 45% of companies, startups, they failed because there is no real need for that product services. If you are, let's say, get a product which will get someone move from to the DAS, for example. Yes, it has some utility of that particular product, but there is no real need. Okay, that there is a very limited market size for those product or services. So that is why you have to look at where there is a real need for the product which they are actually developing, although proof of concept is yet to be established. Okay, so that anyways for any early VC stage companies, you have to assume that proof of concept is not there. That is where you look at in the deep tech segment. Okay, what are the how many transactions happened at what pre-money valuation. I was giving this example, and those pre-money valuation, you have to take it as it is. You don't try to calculate, hey, this pre-money valuation of $5 million suggesting an implant multiple of 10x. No, because most of these companies wouldn't have started or there is no proof of concept which is established. Hence, there is no revenue, there is no profitability. Has no point calculating EBITDA multiple. You simply look at pre-money valuation, whether it's 2 million, 3 million, then you try to benchmark. Okay, hey, I got one deep tech company which also raised early VC stage investment at let's say $3 million. How can I compare? Okay, I'll compare, what exactly the product they are developing. Whether my product is better. Now, when you talk to some of these tech companies, they say, hey, they are building this product in old language. I am building a new language. So of course, there will be a lot of technical aspect which you need to carefully determine. So then you look at, hey, who are these guys actually? Are the founders? Okay, we realize the company which you are valuing, their founders are actually they've spent their life in tech segment. Hence, if they are building versus the other comparative company which you have taken, they are actually they have the idea, they got the idea, but they are the not one actually who can do coding. they can come out. That is where actually you do some of this comparison and try to say, okay, hey, I think we should be valued slightly higher than the benchmarking VC investment you took, and we took for your comparison, and decide, okay, whether the 5 million should be 6 million or 10 million. Those subjective adjustment will be there, but you will be able to objectively assess whether our company should be better or not. Whether better by 10%, better by 100%, those I think subjectivity still be there in such a scenario. Any other questions on market calibration before we move to CCA? Yes, sir. Listed company is not required. Okay, listed company, because anyways it is publicly listed. Only thing what we do that, okay, there are times where you think the listed price is not the true reflection of what is happening in the company. Okay, even if there is a decent history, then you need to have a lot of data points. It happens actually. We have done few dispute engagements where actually we had to demonstrate that, okay, even though decent volume is there, still why the price is not fair. We have seen, like, for example, the SPAC listed, it's a classic example. All SPAC listed companies, this crashed by 70 to 80% in last 2 to 3 years. Most of them are, of course, tech companies. So yes, I think it can be applied, but generally it is not that commonly used, because listed company we have much easier way of valuing them. We don't want to get into calibration. Yes.
What references you use for seeing market comparable, like specific software subscriptions you have, or is it something you track in-house?
Yeah, so there are two things. One is, there are certain databases which tracks early stage company investments. One is in terms of multiples, of course, public company multiples, you can get Capital IQ, all of these databases. When it comes to early stage company, yes, yeah, I think PitchBook is there, which gives probably it will have a little more wider coverage in terms of early stage company. Second, lot of time what you can do also, by tracking first that, okay, what are the deals happened, okay, doing your normal Google screening, that these are the deals happened, then you will be able to find some clue, okay, in terms of their revenue, okay. These days, of course, a lot of companies, the MCA website, you get their financials. You can do some calculation also on your own, but yes, if you want to have ready-made, maybe PitchBook is merger market probably will have a little wider coverage. Any other database we use? Private circle is actually pretty good. Okay, that I think so far as Indian comms are concerned, because I think they have connect to these bankers and legal fraternity, and where they get some of these data points. Private circle. PitchBook, private circle, merger market, these are the three where you get, I think, more private deal information. Okay, we'll move to, contingent claim analysis. So how many of you, heard about this term? Yes. Okay, so, so contingent claim analysis, as I was, giving this, earlier example, because most of the, again, this will only be applicable when you're valuing early stage company. Why early stage company? Okay, or you think the company has actually, liquidation preference, which will be very close to, or more than 50% of the company valuation we're talking about. Now, in a situation, you think, hey, there is a liquidation preference, which is, the companies or the, companies agreed to its investor, but that liquidation preference total, if I add, okay, that comes to, let's say, $100 million, but the company currently is valued at $1 billion. Now, no scenario that, this $1 billion company can come below 100 million also. The probability of that is less. Okay. Now, where CCA becomes more applicable, when you think that sum of all liquidation preference, if you add, okay, and that is coming probably 50% or more, okay, of the company valuation is getting, not 50%, maybe 30 to 40% and more, when actually of the overall company valuation situation. That is the situation where CCA becomes critical. Okay, and why CCA being used, as I said, because there are different classes of shares, and primarily most of the early stage companies, investors will come at preference capital, because to have some protection in terms of, if there is a deal happening tomorrow at a valuation which is lower, where they are not getting their required return, and that is where actually this liquidation preference will kick in, and that is where you can use. And this, the approach is, it may sound complicated, it's very, very pretty straightforward. You have to use Black-Scholes model to value, to do a contingent claim analysis. What it says that, okay, in CCA, again, starting point is your last round of investment. Okay, when did last round happen? Let's say last round of investment happened at Series E. Okay, at X valuation. Now I want to estimate what is the fair value of common equity, or I want to estimate what is the fair value of Series A. That is where CCA is required. Otherwise, CCA has less of relevance from that point. Let's say you are saying, okay, hey, I want to go for next round of funding, which means Series A. For that, CCA will not help. CCA is basically, it is preparing a waterfall that, okay, hey, current enterprise value of the company is $1 billion. That $1 billion value can go up also, can come down also. Okay, now my overall liquidation preference is, let's say I'm saying $500 million. Now $1 billion going up, of course 500 million is protected, but coming down, that percentage of stake, okay, which preferred capital has in overall enterprise changes. That is why you do those waterfall analysis, finding break point. Let's say at what level, let's say up to, in this example, up to $500 million valuation, preferred will take everything, okay, common will get nothing. Now beyond 500, the common start participating. Similarly, within preferred also, let's say 500, you have a Series A, Series B, up to Series E, okay, and different classes of preferred would have come at different liquidation preference, and your break point for Series A could be different than Series C, because first, and lot of times they will be pari passu. For example, let's say Series A, came at let's say 10 rupees per share, whereas C came at 100 rupees. Tomorrow, if the deal happening at let's say 50 rupees, that which means Series A also come down, because they will not get that 10, because Series E is not getting 100. Okay, so accordingly you calculate a weighted average number. Yes. So basically, shareholding goes up. Generally, these are convertible structure, and the conversion is linked to your. One is conversion will be protect that I should get, let's say 1:1. Okay. Now second, that 1:1 should give me minimum liquidation preference. Sometime okay, I should get minimum liquidation preference. I should get an IRR also 10%, which means let's say I put money 10 crore, okay, as a preferred, okay, and my liquidation preference is 1x. With an IRR of 10%, which means liquidation preference for year 1 is 10, year 2 will become 10 plus 10% of 10, which is 1, 11. Next year will become probably 11 plus 1.11 plus 1.1. So that is your liquidation preference will keep changing, okay, as you are moving forward year on year, if there is an IRR is also being agreed to the preferred capital. Yes. And of course, there are situations you will find, there are, CCD and CCPS, okay, and CCD will have a, preference over CCPS. Hence, you prepare breakpoint accordingly. That okay, until CCD is getting, retired or getting paid out, CCPS will not get. So you create, okay, until let's say CCD total investment is $50 million. Up to $50 million, you say CCPS common doesn't get anything. Similarly, next breakpoint comes, let's say until 550, because another 500 is there from preferred. Until 550, CCD, CCPS will participate. Beyond 550, then of course everybody participates. You want to take the example maybe?
So just adding on to what Umakant said, right? CCA is not primarily a valuation approach. It's more like allocating a value. So today, why do we do that? Because different class of shares have different liquidation preference, okay? So if someone is investing at 100 rupees, okay, and has 1x liquidation preference, so what does that mean? That up to 100 rupees of equity of the overall company value, all the money will flow to that investor and nothing will go to common. So it's not a valuation methodology per se, but it's more of allocating the value that you've determined. So say, for example, we determine the value of the overall company or the subject company based on calibrated market approach. Okay, so we got, say, 1,000 rupees. Now, how this 1,000 rupees will flow to different class of shares, and that's when CCPA comes to a play. Okay, now under which scenarios CCA may be utilized. Okay, so like Umakant mentioned, early stage and venture stage companies, when the company has high debt, okay, if the company is very highly levered, there is a risk to the equity shareholders, and hence you use a CC analysis. The second, when do you not use it? So I think, sir, you previously asked Umakant that, what if it's a going concern company, right? Just to add on to what Umakant mentioned, that when you're valuing a company, right, the underlying assumption that you use is that the company is going concern, okay? What we additionally look at, or whether CCA will be used or not, if the company or the option price is way out of the money or way in the money. What does that mean? That I have a liquidation preference of 100, okay? But the company's value is, say, 10,000. Does my liquidation preference have any value? No. Why? Because if I convert, say if I have 10% shareholding, if I convert my shares, I'll get a value of 1,000, 10,000 into 10%. So there I won't use my LP, okay? Even though I have that right, I will not use that right. I hope everyone's clear till this. Okay. So moving quickly to the example. So this is an example where company X receives 1 million investment in form of 1 lakh Series A convertible shares, and it has 4 lakh common shares, okay? So by this, can we say that the company value or the equity value is 5 million? Will that be correct? Anyone, any thoughts? Let's build this. I'll move to the next page. So, like I said, okay, CCA per se is not a valuation methodology. It's more of allocation. So here I'm just going to show you how the payoff moves, okay? Say today the common equity value is 1 lakh, okay? Not common equity, the company valuation is 1 lakh. What does this mean for common shareholders? Does this mean that the common shareholders value is 1 lakh? No. Why? Because in the example, just moving back to the example, there are preference shares with 1x liquidation preference. When I say 1x, whatever I've invested, that same amount I have a liquidation preference. So if I've invested 1 lakh, up to 1 lakh I'm secured. When I say secured, it means that any money going to equity shareholders, before that it will come to me, up to that 1 lakh amount, okay? 1 million. So when the company valuation is 1 million, the entire money will ideally be for preference shareholders and the common valuation will be 0, okay? Now moving on to if the company valuation is, say, 2 lakh, okay? So the first 1 lakh will be for preference shares and the balance will be now common equity, okay? Now when will it be beneficial for this preference shares to convert, okay? So a simple math, okay? 1 lakh and they have, say, 20%, right? 20%, if they convert, they will get 20% shareholding, 1 lakh shares, and the total shares will be 1 lakh on 5 lakh, which is 20% share. So only if the company valuation, okay, moves beyond 5 lakh, will it create benefit or value to this preference shareholders, okay? So if the company valuation is, say, 6 lakhs, okay, 6 lakhs if they convert their shares, they'll get 20% share. The value for CCPS will be 1,20,000 as against their LP of 1 lakh. So it's beneficial for them to convert. And the balance value, which is 4,80,000, is for the equity shareholders. So this is just what we discussed, that at each stage, the value to allocated to preference shareholders versus equity will be different based on the rights that they have in the cap structure. So this was an example that Umakant earlier mentioned, that we did it for a US-based client where there was an arbitration between a promoter and another shareholder, where the promoter wanted an exit and told that the exit should happen at recent round. Now the recent round was a preference round where the preference capital had some additional liquidation preference. Like I told you, right, moving on to the earlier payoff, that up to a certain point, say up to 1 lakh, the common shareholder had zero value, right? So if today the common shareholder came and told that, no, 1 lakh is the total value, irrespective you give me that, that won't be correct, because there is another stakeholder sitting in your cap table which has a right on that value. And hence, CCA plays an important role when there are various classes of shares. If there is just common equity in your cap structure, CCA won't be relevant. Yes. 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 It will still work. So ideally, the way this works is, if say you have, ideally it will never happen that one series will have different right. It will usually be series A, A1, A2. The minute it gets a differential voting right, it will have a different series name. But if there is anything different, it has to be carved out separately.
Maybe just to add actually, I think where there is a practical usage to your example. I don't know how many of you do AIF, fund valuation, which is now mandatory by SEBI. I think semi-annually. So now let's say your client had invested actually in Series B. Now our objective is, what is our mandate to find out, okay, our client invested in Series B, what is its fair value on reporting date. Now the company, okay, the company has recently raised a Series E, so you know the price point. Can you take Series E valuation and simply multiply, our client stake, okay, hey, based on last round, this is our valuation, which you call, price of recent investment, PORI, right? That is only applicable if, if CCA is not, you think whether to do CCA or on a fully diluted basis, the value will not be different, because your liquidation preference is not that much. That is exactly come. Series B has a different liquidation preference. Series E has a different liquidation preference. Hence, we have created a simple example, but you can build that multiple, labels. That you'll have multiple series of preference shares, and they will actually get different payout at different valuation. And why it it sounds like most likely the company valuation will be more than 5 million, because they come because recent investment has come. Now if you do an option pricing analysis, but generally you think, okay, there is a certainly there is a decent amount of probability, if you do this and in Black-Scholes you get more than 50% probability, the company value becoming less than $5 million. If company value, okay, 2 year, 3 year down the line, okay, takes a downward trend, can actually be valued at less than $5 million, and that is where actually this comes into picture. Any other questions on this one? Yeah. 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 So that to think, whether you are using income approach or market approach, you are estimating enterprise value of the company. Like, the enterprise value of the company is actually, needs to be, there has to be a waterfall mechanism, because we know different series will have different payout. Now, in a scenario, you think, okay, current enterprise value, as I is telling you, earlier example, is let's say $1 billion. If I add total liquidation preference, all series, okay, I am getting only $200 million. Which means if $100 billion company value going down to 200 million, that is where actually it will kick in. Okay, that's why now you have to see, okay, whether CCA I should apply or not. Okay. Second, CCA becomes applicable if the company is seeing any down round, which means now down round has happened, new round has come at, let's say, whatever price, but earlier round has higher liquidation preference. That is what going to impact. Second, as I said, I mean, our objective will be, because AIF is our client and we are valuing earlier series, because that is what they hold. Okay, because the company values has not gone up significantly, hence CCA will be critical. But it's just that, I think typically older series will have a lower value, and lot of clients will push back, no, we should do a price of recent investment. Then you have to build a story. Okay, unlikely that the valuation will be down to such a level that we should we should value the investment in CCA. So we to look at almost over 400 positions on a quarterly basis in India, and not more than 50% actually, or 60% scenario we end up doing CCA. Because one is there will be a lot of time you don't get detailed cap table. You need to have detailed cap table. All those earlier series, they are rights. Then only you can actually build a can't CCA. Other you can't do it. If you don't know, you just only know there are different series and without their liquidation preference and other conversion rights. Yeah, SPA. All SPA. SPA will have all the details. No. It's not it. No. Yeah. Right. So what it does, put in simple, let's say either you are using income approach or market approach. Let's say take income approach. You done income approach, you estimate enterprise value to be $100 million. Now, then 100 million up to $100 million, you create a break point. Let's say you have 5 different series. So you say, okay, $0 to $10 million. Okay, if the company valuation today is $0 to $10 million, this is the payout. Everything will go to series D. $10 million to, let's say, $20 million, that will be split between series C and D based on their amount of investment. Similarly, prepare a simple breakpoints. Now in the then Black-Scholes, what it does, it will basically, your current valuation is there, it try to calibrate, saying, okay, there is a possibility company value may go up or come down. What you use your risk rate, which will be in this case, let's say, if it is Indian investment INR risk rate, and you look at volatility. Using that, it basically says, okay, do the option pricing analysis like you do ISO valuation. Exactly the time value of money you estimate, exactly same thing it does. So we also prepared FDS. I don't know, it's straightforward. I know typical market approach. I don't know whether we have time. If we have time, we can go through. Otherwise, yeah.
Actually, instead of FTS, we'll just quickly, analyze how CCA works in different scenarios. Okay. So like Umakant mentioned, right, like we face quite a few challenges where an early investor has invested in a company at a very low valuation and now the valuation has shot up. When we do a CCA analysis, the value will still be lower. Okay, and sometimes when you show a value based on FDS is nothing, but you take the most recent round and you apply that value to the entire share cap table, irrespective of what their rights and preferences are. Versus CCA considers or gives an impact of these differential rights in the cap table. Okay, so this is an example. Say for example, the Series A was done at $0.24. While the Series E happened at $7.8, right? So Series A is gradually going to come to you if say the investor is in Series A, like please give me a valuation of 7.83. So how do you justify that? So of course there are various reasons to justify, but here what will help you is this CCA analysis. So you get to an equity value, say $100 billion. From there, based on the different LP, ideally, what would have happened that for Series A, the most beneficial would be to convert at this point because the LP would be very minimal to the initial investment amount and it will be beneficial for them to convert. So how do we portray that? So if you see there's a value given that Series A, the CCA value is only 3,600, but the FDS value is 7,800. Okay, so for them, it's ideally beneficial to convert. So this CCA analysis also gives a perspective to investors of when to convert, or is it beneficial for them to convert at this point? Moving on to the next case study, where there is a down.
One aspect, no, if you go to previous, if you see, we have, let's say, you are estimating value under different methods. You are doing CCA also, and you are doing fully diluted basis. Okay, you give different weights. Okay, to decide, okay, I should give equal weight. I'll give, higher weight. That depends on, time to liquidity. Okay, you think, down round is happening, company valuation is moving. That is where actually you decide whether I should give, higher weights to CCA or lower, higher weights to FDS. Second, also you look at, okay, the complexity, or let's say, you are valuing for a particular fund. They have been actually investing in different series. They have not only investment in series A, they have also put money in series E. If you think the fund for which you are doing the valuation, they have investment in multiple series, then you know that, okay, one series they may lose money, one series, other series they may make money. You may decide to do a, FDS or give higher weight to FDS.
Thanks, Umakant, for adding that. The next point is what Umakant mentioned. So, for example, here you see that there was a weighting that was given as 40% to CC and 60 to FDS, and that was because the liquidity event was near. The second case is where a down round had happened. Okay, when a down round happens, you ideally give a higher weight to CCA because there's a higher risk that you will, for your LP. When I say risk, it means risk of conversion. You will ideally not convert, and you will take the benefit of the liquidation preference that you have. So in this case, what happens is your CCA value will be higher than the FDS value. And why will that be? Because you have that liquidation preference. And the liquidation preference of an earlier round, which was an up round, will be more than a down round scenario. So for example, here the series B2 was a recent round, which was a down round. And the investor had invested in series B, which was a higher stake round. So what had happened, that the CCA value was more than the FDS value just because of the liquidation preference. To give in simple terms, say the company value today is 1000, okay, when you invested, and you have 100 rupees of preference rights. Now the company valuation has become 800, okay. On an FDS basis, the overall company will still be valued at 800, but for preference dividend, right, when you do CCA, your investment will actually be 800 into 10% plus that preference that you have of 10 rupees. So maybe 90, and not a direct percentage of that recent round. This like a simple math. Yeah. No. Liquidation preference is for that stock. It's not overall company, right? So only for that cap table, like a series, will that value be more? Yeah, it will not flow to common stock or the overall equity value. Yeah, the total equity will still be 800. The total value of the company is still 800. But for you as an investor, maybe your value is not a direct proportion of that 800, just because you have a higher liquidation preference. Yes. Huh? Yes. No, so even when a liquidation scenario is happening, right, whatever, say for example, the overall value is now 1 lakh, like overall cash remaining is 1 lakh. And as a preference shareholder, you have, say, liquidation preference of 1 lakh. The entire money will still flow to you and common will get 0. So your, even in the liquidation scenario, your liquidation preference still holds some value. Yes? Yes, that's very right. It can be different. So first we have to understand, why this liquidation preference. Okay, anyone putting liquidation preference in their SPA is to secure the investment that they are doing. In case something goes wrong in the company, at least whatever I've invested, that is secured, and I have a preference over equity to that amount. Like you mentioned, yes, there are various. Sometimes it's 1x, sometimes it's 2 times of what you invested, sometimes it's IRR, sometimes it's based on company performance or milestones. So it can be on various parameters.
And just to, I think, performance link generally classified as a conversion rights. Like,
Yeah.
at what price I should be converted? Okay, you didn't achieve X growth rate, Y profitability, hence my conversion will be different. So otherwise, liquidation preference is a term generally linked to what money you put. Okay, you are putting X money, you should get 1x of that, 2x of that, you should attach a 10% IRR, 20% IRR, but performance related, conversion, performance related, adjustment should be classified as a conversion rights. That will be, easiest way. No, we don't consider that because we don't know. We are not in CCA. Okay, CCA is being done using Black Source model. Okay, any revenue, any KPI simulation we call it, or KPI projection, which is revenue growth rate profitability, can only be done in Monte Carlo. So generally, here you are saying, okay, this is overall valuation, and based on that, I'm actually allocating the overall value. I'm not trying to see, okay, hey, if my revenue growth rate will go down, okay, and what will be the valuation? Hence, I do. So generally, we don't. I mean, it can be done. You are right, it can be done, but I don't think that's the purpose for which we do the exercise. It is required.
Yeah. So I'm asking that in a general way, I'm just trying to understand the concept that when there's a liquidation preference, does it is subject to adjustment to any dividend or buyback which has happened in the past, and the shareholders have received some money. So
Yes.
should
Yes.
it get adjusted?
Yes. It is basically you are supposed to get 1x of your investment. Already you have got, let's say, some in the form of buyback or dividend, that will be adjusted.
Thank you.
Yeah, any more questions?
No, that is not possible because if you are going to raise currently you have invested at 10%. Okay, something which you have seen that there is a cap and floor is being agreed. Okay, because you don't know what will the valuation, and you say, okay, my valuation should be, let's say, 20%, a discount to next round. Okay, but with a cap and floor, only with respect to when next round happens. The next round happens, okay, you recalculate 20% discount to next round. It is giving you, let's say, 2% stake in the company, but you had agreed that minimum stake I should have 2.3%. So then you get 2.3% stake. Accordingly, rest all get diluted, but that stops there. That is only for up to that round. Then subsequently it will changes. Fresh shares. No, it will not happen fresh shares. Accordingly, the new investor shares will be adjusted in such a way that this guy is getting 2.3%, and if it required, of course, there will be a fresh shares. I guess. I mean, I know a little less actually in terms of Companies Act. So yes.
Usually in the anti-dilution, usually what we have seen is kicks in and where there's a lower valuation round that happens, right? Because that's when your interest is impacted. Usually when a higher valuation round is happening, the stake at higher valuation, the dilution is minimal. And for any company, which is in growth phase, they have to go through multiple rounds. And the company will ideally not, give anti-dilution for having multiple rounds. It will be to the extent that the investor is impacted, and that happens when there's a lower value round happening in the company.
Any round happening actually doesn't require to be additional shares to be issued,
Yeah.
because this CCPS or the preferred has this right. Whenever they're converting only, then additional shares to be issued. Now there is a deal has happened. I know earlier I was holding 2% stake, because there is a down round, by default I become 2.5% stake. Okay, that doesn't mean you will get any additional shares right now. Whenever there is a, exactly,
Yeah.
termination.
Any other questions?
Okay, we are good then.
Yes. Thank you for your time.
Thank you everyone.
Thank you so much, Umakant and Ami, for such a beautiful and insightful topic elaboration over the valuation. Your explanation of market calibration, along with its critical role in assessing the risk and opportunity, was really helpful for all of us. Thank you. Please give them a round of applause. We can break for 15 minutes for tea probably, and then again chip in for last session of the day. So welcome back after the short tea break we had. Moving towards the end of the session and probably the another insightful session for you all. Before we start and head towards our new session, I would like to invite and call our chairman of WIRC, Mr. Ankit Rathi, and Gautam Lath, Secretary WIRC, over the dais, please. Along with, I would request Mr. C.A. Nishan Soni along to come up. Before we, sir, can we have the memento first? And then probably you address the crowd. सर जैसे आप बोलो पहले अपन मोमेंटो कर लेते हैं एक छोटा सा Mr. Ankit Rathi ji, please could you just come over the dais and address the crowd? First Gautam sir. Okay, so Gautam sir, please.
Hello everyone. Only one appeal I would like to make before I hand over to chairman. So everybody knows, I am sure, that we are up for the election on this 6th and 7th. Don't worry, I am not contesting and I am not here for canvassing. I hope everyone knows that this year the tenure will be of the 4 years instead of 3. So friends, sometimes we talk about that ICI should do this, and this is how our profession should work. My only humble appeal to each one of you that if you see our voting percentage, it is very low. We are at a Mumbai, we are voting at a 40% of average, which is far below than the national average of voting. So, and we are the most educated class, as we call ourselves, that one of the toughest exam we have passed, and this is how we are reflecting when we are choosing our representative who will shape the future of this profession in the next 4 years. So my humble appeal to each one of you that let's take a place today that all of us will vote in maximum capacity in this election. You have got the profile, the institute has sent a booklet to your home. You can read the profile. If you know a candidate, you can vote for him. Whatever better candidate you feel that should be right for the institute, my humble appeal that let us vote in maximum capacity. Encourage our our colleague, family members and friends also to vote, and that's the request I have to make from you. Now I hand over to our chairman, C. Ankit Rathi, for his address.
Very good afternoon. It's absolute pleasure to be here with you all. At the outset, let me first thanks to our today faculty, C. Nishan Soni ji. Nishan bhai, thank you so much. Despite of your so much busy schedule, you accept our invitation and being agreed to share your valuable knowledge with our participants. Let me also thanks to Charul Jain. Charul, thank you so much for your time to the fraternity. Friends, I will not take your much time. I just wish to share you about the one of the initiative of ICI and wish to request about the one of the activities of the ICI, you can say. Let me share you about the project Punashya. Friends, when we are traveling to tier 2, tier 3 city or in a small villages of Maharashtra and Gujarat, then we come to know various females member who took the break because of their family reason. शादी हो गई, उसके बाद 3-4 साल का break आ गया. They are unable to restart their professional career as per their desired. The reason behind this initiative of project Punashya, मेरा एक दोस्त है, उसकी वाइफ का मेरे पास एक बार सडनली फ़ोन आता है आफ्टर बिकम काउंसिल मेंबर कि भैया मेरे को कोई जॉब हो तो बताओ. मैंने कहा आपको ये बना तो इतने साल हो गए, अभी आप जॉब ढूंढ रहे हो? तो बोले नहीं, मैंने 7 साल तक आदित्य बिरला में काम किया है, अभी शादी के बाद कुछ 4-1 साल का ब्रेक आ गया, अब रीस्टार्ट करना है. मैंने कहा ठीक है, मैं कुछ होता है तो बताता हूँ. अगेन 15-20 दिन बाद में रिमाइंडर आया. उसी दिन कोइंसिडेंटली मेरे एक दोस्त का भी फ़ोन आया, यार अंकित कोई सीए है तो देना. और एज यू ऑल नो, मुंबई में छोटी फर्म प्रोप्राइटरशिप या छोटी पार्टनरशिप फर्म को सीए मिलना डिफिकल्ट हो गया है. व्हेन आई वाज क्वालिफाइड, एवरेज पैकेज ऑफ सीए अराउंड 5 लाख और 5.5 लाख, और अभी हम लोग कैंपस में थर्ड डे मिनिमम 10.5 ऑफर कर रहे हैं. तो एक छोटी फर्म्स को अगर सीए चाहिए तो 15 लाख 12 लाख मिनिमम देना है, उसके बाद भी मिलेगा कि नहीं मिलेगा गारंटी नहीं है। मैंने कहा दोस्त बताता हूँ। तो मैंने क्या किया, दोनों को एक दूसरे के नंबर एक्सचेंज कर दिए। कुछ टाइम बाद फॉलोअप लिया। मैंने कहा भाभी कैसा रहा? तो बोले भैया बढ़िया है, मेरे को ये 60,000 रुपये दे रहे हैं महीने के, और 6 घंटा काम करने रहता है घर से, कभी भी जब इच्छा हो मैं कर लेती हूँ, कभी अगर प्रेशर रहता है तो रात को भी करके दे देती हूँ। मैंने दोस्त से फीडबैक लिया, मैंने कहा भाई क्या ठीक काम कर रही है? तो बोले नहीं यार अच्छा काम कर रही है, होशियार है वो तो, सस्ते में काम हो रहा है। मैंने कहा बढ़िया है दोस्त। तो इस तरीके से फिर हम लोगों ने पुनश्य स्टार्ट करने से पहले 3 एम्प्लॉय गौतम के ऑफिस में हायर किए, एक जालना से, एक पोरबंदर से, एक विरार से, फीमेल अगेन फीमेल मैरिड फीमेल मेंबर्स, एंड दे आर डूइंग जीएसटी रिकन्सिलेशन वर्क, 3B 2A मंथली कंप्लाइंस हो गए, कुछ नोटिसेज आए तो उनका रिप्लाई हो गया, डिपार्टमेंट के काम नहीं जो घर से काम कर सके, एंड अगेन दे ऑल 3 आर डूइंग वेरी ग्रेट वर्क, राइट गौतम? तो हम लोगों ने एक टैब स्टार्ट कर दिया वेस्ट इंडिया रीजनल काउंसिल की वेबसाइट पर, पुनश्य रीस्टार्ट। और अल्टरनेटिव साइड हम लोगों ने एक एचआर कंपनी है जो पुरानी 20 साल पुरानी एचआर कंपनी है, जिनका मोर देन 250 कंपनी से टाई अप है, उनके साथ एक MOU साइन कर लिया कि भाई जो जो CV आएगी, किसी को फुल टाइम चाहिए, किसी को पार्ट टाइम चाहिए, फ्लेक्सी या वर्क फ्रॉम होम, आप एटलीस्ट मोर देन 90 to 95% प्लेस करोगे उनके डिजायर्ड के हिसाब से। आप मेंबर से 1 रुपया नहीं लोगे, हमारे इंस्टीट्यूट आपको 1 रुपया नहीं देगी, नहीं हम आपसे 1 रुपया चार्ज करेंगे। आपको कंपनी से अगर कुछ मिलता है तो हम आपको क्वेश्चन भी नहीं करेंगे, पर हमको ये एश्योरेंस चाहिए कि भाई डिजायर्ड जॉब सबको मिले। उस तरीके से हमने MOU साइन किया, और वो पुनश्य का टैब अभी लाइव है। माई 2 humble रिक्वेस्ट टू ईच वन ऑफ यू, फर्स्ट अबाउट, अगर इफ यू नो एनी सच काइंड ऑफ फीमेल मेंबर हु आर लुकिंग फॉरवर्ड टू रीस्टार्ट, प्लीज डू लेट देम नो अबाउट द प्रोजेक्ट पुनश्य। वो WRC की वेबसाइट्स पे जाके अपना अपडेटेड रिज्यूम CV जो भी अपन बोलते हैं अपलोड कर सकती है। एंड अनदर सेकंड रिक्वेस्ट, if you are looking for chartered accountant, please do consider such kind of female member. They are really doing great work. This is 2 humble request from my side to each one of you. And the last request, my role at the WIRC, we are looking forward more and more speaker contributor in our newsletter, in anyone publications, in our reference manual, or if you wish to contribute in any another way, please do write my role at the WIRC. We are happy to associate with each one of you. With this, I wish all of you happy learning. Thank you so much.
Thank you so much, CA Ankit Rathi and CA Gautam Lat, for your insights. I would just like to make a small announcement, which I had got a feedback from the crowd. During the circulation of the feedback form for our faculties, for our speakers, the first name of the speaker written in your manual is Vaibhav Manik, right? So while you are giving a feedback, you are actually giving it to Urvish Mehta, Mr. Urvish Mehta, due to some last minute medical emergency which happened in the morning. That is the reason it was a switch, and that is why. So if please give the feedback for Mr. Urvish Mehta, and team will accordingly collect those. Okay. Moving ahead to the last session, which stands for valuation of AIF. Valuation of AIF. Let me introduce our speaker here, Mr. CA Nishant Soni. Nishant Soni is a business valuation specialist, is a registered valuer recognized by Insolvency and Bankruptcy Board of India. He is also a diploma holder in Diploma IFR by ACCA United Kingdom. He is the member of Committee of MSME and Startup of ICAI WRC, and also the conveyor at Valuation Study Group at ICAI WRC. He qualified his chartered accountancy in 2012 and is a practicing chartered accountant since a decade. Based from Mumbai, he has been dealing in specialized cases of business valuation, due diligence, structuring a deal from startup companies to listed companies. He has been working closely with startups by helping them in preparing investor documentation and thereby guiding them to raise funds from family offices, venture capitalists, and HNI investors. He himself is an angel investor to various startups. Nishant is currently a valuation partner working with many investment banking companies. Nishant has also been incubating startups and have been acting as the active advisor and mentor to build a growth story dedicated to nation. Thank you. Please, Mr. Nishant Soni, the dice is yours.
So good evening, everyone. So let's begin with the topic valuation and AIF. Okay. So before going into valuation part, let us understand what is AIF. So you all have heard about AIF, right? Surely it was there in our syllabus. We studied at one point of time. Maybe after that the concept got more developed. Okay. And after that it has become an alternative for investment. So when we say alternative, earlier we had options to invest in equity market little easily, but then once the portfolio was big and we wanted to diversify, so came out with alternative funds, right? So that's the whole background, right? But apart from this name, do we have some more idea, like who is regulating it? Any idea who is regulating it? SEBI? Yes, perfect. Okay, and can we have some examples, like what kind of AIF you've heard, what kind of funds are present in the structure? Yes, venture capital, right? Sorry? I heard private equity, I think. Real estate funds, yes. Debt funds, correct. Right? Hedge funds, correct. Sorry? Social impact fund, absolutely right. Correct. Angel fund, very right. I think I've covered all, I think. So there could be commodities fund also, which invest into commodities. So these are like some examples of AIF fund. So broadly, it is a collective investment vehicles, right? Which gathers investment which gathers capital from investors. And accordingly, a fund manager is appointed and he accordingly takes a decision to either showcase a deal to the investors or invest by his own powers, right? Okay. So let us understand that there are some categories in AIF, right? Have you heard Cat 1, Cat 2, Cat 3, right? Yeah. So anyone, Cat 1, what is Cat 1? Can someone try? Or what kind of funds they invest into? Listed space, no. Startups, yes. Correct. Right? So they invest in startups. So there could be some examples could be venture capital funds, could be angel funds, right? So these type of funds invest in early stage type of companies, right? Then we have Cat 3. Cat 3 is into hedge funds or even listed companies. And so Cat 2 is balancing, which is not covered in Cat 1. Cat 3 is covered in Cat 2. So kind of real estate funds are covered in Cat 2, right? So these are some examples. We can go in detail to understand some basics about what is Cat 1, Cat 2, Cat 3. All right. I'll just remove and try. Okay. It's connected. So I think in meanwhile this gets fixed up. I think there's also called something called infrastructure funds. Okay, these are some funds, some examples. Hello. So I think in meanwhile this gets fixed up, we can continue. So it is more, I would say, a discussion session only, so doesn't matter. Okay. So when we say Cat 1, Cat 2, Cat 3, like these are three broad funds which we're discussing. So for example, if we have something in Cat 1, some examples could be venture capital funds, social venture funds, SME funds, typically targeting small and medium size funds. Okay. When it comes to Cat 2, normally private equity is there. Okay, it's there, right. Right. Okay. So coming back to Cat 1, 2, 3. So definition wise, we understood the basic aspect, what kind of funds Cat 1 are, Cat 2 and Cat 3 are respectively. Okay. Going to the next one. So like if we speak about some examples in Cat 1, so you must have heard Mumbai Angels, these kind of funds you have heard, right? Some venture catalyst, etc. So these are like some funds which are Cat A type, right? Then if some companies are there which invest only into stock market, so they normally form a Cat 3. So like it is very specifically defined, and accordingly the framework is done for preparing such kind. You prepare PPM and submit it to SEBI, and accordingly AIF is formed. So it's a long process, but just cut shorting, I'm telling you the quick process. Some important aspect is that what would be the tenure of AIF. So normally these are built with some tenure. So typically it would be mentioned in PPM, but ideally in ideal scenario, Cat 1 is normally for 7 to 10 years time. Cat 2 is normally for 5 to 10 years time, and Cat 3 is normally short term, can have little bit higher period also, but generally tend to be short term also, because at the end it is with that horizon. Okay, so that could be one of the objective. And importantly, if we want to speak on taxation part, how taxation happens in AIF, so Cat 1, it is very clearly mentioned that it's a pass-through income. So nothing is being paid by the fund. It's pass-through income, means investor has to bear the tax and pay. But Cat 2 and Cat 3 is like a tax-free income which has been given to the investor. So the taxes are paid by fund level itself, right? So other things have been reported. I'm sure in presentation you can get it. But we want to focus more on valuation part, so that's why I'm just skipping and jumping to the next slide. Right. So now, does the portfolio what is there in AIF needs a valuation is a question, right? Technically it is yes, SEBI says so that you need to undergo a valuation, okay. But then who can be an valuer? So SEBI says an independent valuer. So what is the qualification for it? So the qualification is as per circular dated 21st June 23, where they specified that first of all, an independence is an important criteria, that the person should not be an associate or a manager or a sponsor or a trustee in that AIF, right? The second thing is experience. So SEBI prescribed that minimum 3 years of experience in unlisted securities is a must. And there's some more conditions. So out of the third condition, any one of the two conditions should be satisfied. So what are those two? The valuer should be registered with IBBI and holds a membership in either ICAI, ICSI, cost accounting, or CFA. Alternatively, in case you are a holding or a subsidiary company of a credit rating agency which is registered with SEBI, then you are also entitled to perform valuation exercise for these kind of AIF. Right? So these are broadly some criteria. So the next question comes then, okay, suppose we are a valuer, we are eligible to do it, then what next? What methods we should adopt? So I think we, since morning, we had good sessions on various types of methods, and Mr. Umakant has also covered IPEV guidelines. So IPEV guidelines is actually prescribed method for valuing AIF. So when we say IPEV guidelines, what are the methods covered in that? So there are multiple methods which has been prescribed. So I think we'll be just going through these methods overview. I'm not going into much detail because these methods we are all generally aware, and plus it has been covered also in the earlier sessions. But what does IPV guidelines speaks about? It speaks about market approach, income approach, replacement cost, calibrating to recent transaction, mathematical model, and the below ones is debt investment, scenario analysis, adjustments to marketability and restriction, and ESG consideration are some scenarios. So we'll look into it in a separate way, not as a method point of view, but these are the things that we'll just